ladies and gentlemen. This is Casey O'Rourke here at Fross and Fross Wealth Management, bringing you this week's economic and market update. Hopefully this finds you well. You had a very nice Independence Day. Sure is hot out there with these summer months coming in. So before we get started, remember anything mentioned today is not a recommendation. Feel free to read those disclosures attached within the email, as well as on the website www.frossandfross.com. Starting off, we know it's old news at this point, but I think it's fair to mention that back on June 8th, the S&P entered into a new bull market. After such a strong rally off the October lows, this young bull probably needs a breather at some point soon. As we look at the charts, they may suggest this market may be due for a pause. Nobody knows when. However, the impending end of the Fed rate hiking campaign and the economy's and corporate America's resilience help make the bull case that steers us towards more of a neutral rather than a negative view. And you know, the new bull market has arrived. The S&P 500 has climbed into bull market territory after rallying more than 20% off of the October 22 lows, establishing October 12, 2022 as the bear market low. Hopefully we never go back to that, but you just never know. It took 165 trading days for the S&P 500 to surpass the 20% threshold off that bear market low, making the second longest period to confirm a new bull market in nearly 75 years. Pretty interesting data there. While the 20% qualifier meets the technical definition of a bull market, there is additional evidence supporting the transition from a bear to bull market. First, it's the demand for equities continues to rise, forming a series of higher highs and higher lows from October. This uptrend has further been validated by the S&P 500 index crossing back above its longer-term 200-day moving average. Second, while leadership remains narrow, participation in this year's rally has been cyclical. Communication services, consumer discretionary, industrials, and technology enjoy the best sector breadth and the highest percentage of stocks outperforming the market this year. Meanwhile, defensive sectors such as consumer staples and utilities continue to underperform with relatively weak sector breadth. And lastly, bull markets are not linear. Please remember that they don't go in a straight line, and with the S&P 500 well extended above its uptrend, we suspect a pullback or pause is likely. The S&P 500's relative strength index, also RSI, a momentum oscillator used to measure the speed and magnitude of price action, recently reached its most overbought reading since November of 2021. However, the good news with the bull market is that mean reversion from overbought levels is typically resolved near the market's longer-term uptrend. For the S&P 500, that technically means investors could see pullback opportunities towards the rising 200-day moving average, right around 3,991 over the coming months. So, following the playbook, this rally, it seems quite powerful based on the 8-month move, but it's really quite ordinary for an early-stage bull market. In fact, the average price gain for an 8-month-old bull market for the S&P 500 is typically about 33.8% based on nearly 70 years worth of history. The median performance at 25.4% is a better representation of where stocks might normally be at this stage because it takes out the ferocious V-shaped recovery and rebounds coming out of the 2008-2009 great financial crisis. I know we don't like to think back to that. And also the early stages of the pandemic back in March of 2020. With a roughly 21% price gain so far for this young bull, the S&P 500 is well within the normal historical range. And of course, we don't know when the next bear market will arrive based on history there. There's a good chance it doesn't show up for quite a while, hopefully. The duration of a bull market can vary significantly. There's no guarantees, and we certainly don't have a crystal ball. But historically, they have been long-lasting, and some stats looking back since 1957, the average S&P 500 bull market has lasted 59.2 months and produced an average cumulative gain of 169.3%. However, remember, bull markets are not linear and have experienced average maximum drawdowns of 13.2%, similar to the average maximum S&P 500 drawdown in any year of 14.3%. So when we wake up January 1st, we do expect a pullback somewhere along the year. Please don't let that panic you. It's something that we anticipate. and try to stay disciplined to your objectives and your goals, and talk to us. If anything changes along the way, please bring it to our attention. So, in summary, stocks have had a strong rally over the past 8 months to establish a new bull market, with the broad market overbought in the short term from a technical analysis perspective and valuations elevated. Stocks may be due for a pause, so keep that in mind. It is something that we do expect to happen sooner or later. But at the same time, the resilience of the U.S. economy and corporate America has been impressive. Our base case calls for a mild and short-lived recession to begin by year-end, but the latest economic data has slightly raised the odds of a soft landing. We just never know. We're basing it on information that we just don't have yet. So please keep in touch with us. We're here to help. We hope that you have a wonderful summer ahead. Stay cool, stay hydrated, and we'll look forward to talking to you soon.